Institutional investors have treated gold and silver not just as commodities, but as silent barometers of systemic risk. The subtle shifts in their markets often precede broader financial moves, yet these signals rarely make it into mainstream coverage. Current patterns suggest more than seasonal volatility. They hint at structural changes that could redefine how these metals behave. But understanding these shifts requires looking beyond headline prices and into the mechanics of supply, demand, and strategic positioning that remain largely opaque. Market liquidity, especially in silver, has been quietly tightening. Reports indicate a divergence between physical holdings and paper contracts, suggesting stress points that few analysts track closely. This isn't merely a function of investor sentiment, it's intertwined with production constraints, storage dynamics, and institutional positioning that rarely align neatly with public reporting. How these forces interact under pressure could determine whether minor disturbances ripple into pronounced market shifts. Gold, in contrast, shows a different pattern. Its relative stability masks undercurrents in global allocation strategies. Central banks, historically large buyers or holders, are adjusting policies in ways that subtly recalibrate risk perceptions. Available data suggests that these adjustments, while incremental, are enough to alter correlations between gold, equities, and currency markets. The question is whether these shifts are temporary tactical responses or signals of a deeper structural repositioning. Silver's trajectory appears more reactive, but the reasons go beyond investor speculation. Industrial demand, particularly from emerging technologies, is reshaping consumption forecasts. Even slight disruptions in mining or refining can magnify these pressures, creating gaps between futures pricing and actual availability. Analysts monitoring these discrepancies note patterns that could influence volatility more acutely than in gold, yet mainstream coverage often overlooks these microdynamics. The interplay between gold and silver prices is another layer of complexity. Historically, the ratio between them has been used to gauge relative value, but current behavior suggests a departure from traditional norms. Market behavior implies that hedging strategies and derivative positions are increasingly influential, creating feedback loops that may amplify swings once they begin. Understanding these loops is crucial for interpreting short-term shocks versus long-term trends. Cross-market influences are becoming more pronounced. Shifts in bond yields, currency movements, and geopolitical tensions interact with metal markets in ways that are not immediately transparent. Reports indicate that traders increasingly rely on algorithmic overlays, which can accelerate movements but also mask the underlying drivers. If these overlays reverse or fail under stress, market responses could be unexpectedly swift. Regulatory frameworks add another layer of uncertainty. While major oversight exists, enforcement and adaptation to evolving trading instruments lag behind market innovation. This creates asymmetries in risk exposure, particularly for smaller participants who may be less aware of systemic interconnections. The implications extend beyond immediate price swings, affecting confidence, liquidity, and perceived market integrity. Finally, storage and physical distribution trends suggest subtle bottlenecks that could matter if stress conditions intensify. Inventory data, when available, hints at concentration in specific vaults and jurisdictions, exposing potential vulnerabilities in the supply chain. If these nodes come under pressure, market behavior could accelerate in ways that historical models fail to anticipate. These patterns raise questions about what might trigger a pronounced market shift and how prepared participants truly are. Institutional flows are shifting in ways that remain partially obscured from public view. Large-scale allocations into gold-backed funds and silver ETFs indicate sustained interest, yet the composition of these holdings suggests more than passive positioning. Analysts note subtle rotations between short and long-dated contracts, implying that some players are anticipating changes in volatility rather than just price direction. The deeper question is how these rotations interact with broader liquidity constraints and whether they could amplify stress if a sudden trigger emerges. On the physical side, mining production reports point to a slow recalibration rather than an outright shortage. Available data suggests certain regions are underperforming relative to forecasts, but the impact is uneven across the market. Storage logistics, transport limitations, and regulatory compliance further complicate the flow of physical metals. This creates a scenario where paper markets may diverge sharply from physical realities, leaving investors exposed to risks they might not fully grasp. The gold-silver ratio, a long-standing measure of relative value, has begun showing anomalies. Historically, deviations from mean ratios were temporary, Yet current conditions imply a structural shift in how both metals are valued. Market behavior indicates that institutional hedges, derivative overlays, and cross-asset correlations are distorting the traditional relationship. The question becomes whether these distortions are cyclical or if they mark a new baseline for comparative pricing. Geopolitical factors remain subtle but influential. Trade policies, monetary interventions, and regional conflicts indirectly feed into metal valuations by altering risk appetites and liquidity allocation. Analysts tracking historical patterns note that these undercurrents often precede sharper market movements, but only become apparent in hindsight. The challenge lies in anticipating how incremental changes in one domain might trigger disproportionate reactions elsewhere. Volatility metrics are signaling a divergence between expectation and realized movement. While gold appears relatively stable, implied volatility in silver has spiked intermittently, suggesting that traders are pricing in rare but disruptive scenarios. Reports imply that these spikes may be reinforced by automated trading algorithms reacting to liquidity mismatches rather than fundamental news, which introduces an additional layer of unpredictability. Cross-asset correlations are shifting as well. Traditionally, metals moved in predictable opposition or alignment with equities, bonds, and currencies. Current data suggests these relationships are weakening or inverting at times, hinting that metals may be decoupling from traditional macroeconomic indicators. This raises questions about whether historical models for hedging and portfolio allocation remain reliable in this environment. Regulatory oversight continues to lag behind evolving market structures. New trading instruments, electronic platforms, and cross-border allocations create blind spots in surveillance. Reports indicate that some regulatory gaps allow for concentrated risk positions to build unnoticed, which could amplify market movements if a correction occurs. Participants may not fully appreciate the extent of exposure embedded in these positions. Finally, physical custody concentrations hint at systemic vulnerabilities. A significant portion of gold and silver inventories resides in a handful of major vaults, concentrated by region and operator. Should operational issues or policy changes impact these nodes, market reactions could be rapid and severe. Analysts caution that understanding these concentrations and the contingency plans surrounding them is essential to assessing broader market stability. Interest from major hedge funds and institutional traders has begun to create subtle tensions between paper and physical markets. Open interest in silver futures, for instance, has been rising faster than corresponding physical withdrawals, signaling potential dislocations if liquidity tightens. Analysts monitoring these trends suggest that even minor shocks, unexpected delivery requests, regulatory changes, or geopolitical events could ripple disproportionately through markets that appear superficially calm. Supply chain vulnerabilities in silver remain under the radar. Reports indicate that key refining hubs are operating at capacity limits, and transportation bottlenecks in high-demand regions could amplify any production shortfalls. Unlike gold, which benefits from larger and more liquid stockpiles, silver's distribution network is comparatively fragile. Market behavior implies that this structural asymmetry might lead to sharper, more sudden price adjustments than historical patterns would predict. Gold's underlying dynamics, while more stable, are shifting in less visible ways. Central banks are reportedly recalibrating reserve compositions, incrementally reducing reliance on other currencies while slightly increasing gold allocations. These incremental changes, while subtle, can materially affect global liquidity flows and relative valuations, particularly if multiple central banks act in parallel. The question remains whether these are tactical adjustments or part of a broader, more strategic repositioning. Derivative overlays are increasingly shaping short-term market behavior. Traders are layering options, future spreads, and cross-asset hedges in ways that obscure true supply-demand dynamics. When these positions unwind or get forced by margin pressures, price movements can accelerate without a corresponding fundamental driver. Analysts warn that the opacity of these strategies masks systemic risks that only emerge under stress. Macro correlations are becoming less predictable. Historically, metals responded to interest rate shifts, inflation expectations, and equity market swings in relatively stable patterns. Available data suggests that gold and silver are increasingly decoupling from these traditional indicators, raising questions about their effectiveness as hedges in current market conditions. The implications for portfolio managers and risk officers could be significant if reliance on historical correlations continues. Liquidity stress tests point to potential vulnerabilities. Market participants report that thin trading windows during peak volatility periods can amplify price swings, particularly in silver. Even modest imbalances between bid and ask levels could trigger sharp reactions, especially when automated trading systems detect divergences. Understanding these micro-level pressures is essential for interpreting broader market moves. Geopolitical nuances continue to influence behavior subtly. Sanctions, trade disputes, and regional conflicts do not always move metals directly, but shift investor positioning indirectly through currency markets and sovereign credit perceptions. Analysts tracking past patterns suggest that these indirect channels can produce delayed yet pronounced effects, especially when combined with pre-existing structural pressures in the metals markets. Finally, storage and custodial practices may become a hidden source of tension. Reports suggest that certain vaults hold disproportionately large shares of physical inventory, concentrated by operator and jurisdiction. If access or security protocols are disrupted, even temporarily, market reactions could be immediate and amplified, particularly in silver. The interplay between these concentrations and market liquidity remains a critical, underappreciated risk factor. Market positioning is showing subtle signs of stress as hedge funds and institutional traders adjust allocations between gold and silver. Reports indicate that large-scale shifts in futures contracts are occurring faster than the underlying physical flows can accommodate, suggesting that paper markets may be temporarily decoupled from reality. The implications are not immediately visible in price charts, but the tension is building beneath the surface. Industrial demand for silver is quietly increasing, driven by sectors that are less sensitive to short-term economic cycles. Analysts tracking these trends note that even small disruptions, refining delays, mining slowdowns, or export restrictions could tighten availability in ways not reflected in public pricing. This raises the question of how well the market can absorb unexpected shocks without triggering rapid repricing. Gold, by contrast, remains a stabilizing anchor, but not without its own pressures. Central bank behavior suggests a strategic recalibration, with incremental purchases in some regions and cautious selling in others. Reports imply that these moves are partly influenced by currency hedging strategies and sovereign debt considerations, rather than pure bullion accumulation. Such subtle shifts could redefine global correlation patterns and influence broader financial flows. Derivative markets are increasingly active, and their influence on metals pricing cannot be overstated. Options and futures strategies create feedback loops that may amplify volatility once initiated. Market participants suggest that the layering of synthetic positions, particularly in silver, can lead to abrupt adjustments when liquidity is tested. Understanding these interactions is critical for interpreting sudden market swings. The gold-silver ratio has started to behave unpredictably. Historically, it has provided a reliable gauge of relative value, but current patterns indicate a decoupling influenced by derivatives, ETF flows, and industrial demand pressures. Analysts caution that relying on historical averages may understate potential risk in an environment where structural factors dominate cyclical behavior. Cross-market influences are increasingly pronounced. Fluctuations in interest rates, currency pairs, and equity markets now interact with metals in more complex ways. Automated trading systems detect and react to these correlations, sometimes exacerbating movements in gold and silver. The potential for unexpected spikes or drops grows when these feedback loops operate simultaneously across multiple markets. Regulatory oversight continues to lag innovations in trading structures. New derivatives and cross-border allocations introduce blind spots in monitoring risk concentration. Reports indicate that positions of systemic importance can accumulate unnoticed, which could amplify market movements if corrective actions are triggered. This opacity creates uncertainty about the market's true resilience. Finally, physical custody concentrations remain a latent risk. Significant portions of gold and silver inventories are concentrated in a limited number of major vaults and operators. Analysts warn that operational disruptions, policy changes, or jurisdictional constraints could trigger rapid adjustments in supply, with immediate repercussions for market pricing. The interplay between these custodial concentrations and paper market positions creates a complex, high-stakes dynamic. Investor behavior is increasingly influenced by the growing divergence between paper and physical markets. Open interest in silver futures continues to expand faster than physical withdrawals, creating a subtle tension that may go unnoticed until liquidity is tested. Reports indicate that some institutional players are positioning for volatility rather than price appreciation, suggesting a cautious but anticipatory stance that could magnify movements once triggered. Supply constraints in silver are beginning to reveal themselves in unexpected ways. Certain refining hubs are operating at near capacity, and logistical pressures are delaying the movement of physical metal. Even minor disruptions could exacerbate the gap between futures pricing and actual availability, leaving the market vulnerable to sudden repricing. Analysts note that these vulnerabilities are more pronounced in silver than gold due to the metal's smaller stockpiles and higher industrial demand. Gold's underlying trends appear steadier, but the dynamics are quietly evolving. Central bank activity, often incremental and opaque, suggests a measured adjustment of reserves in response to global macro conditions. Reports imply that these moves are influencing liquidity patterns across currency, bond, and commodity markets, creating a network of interdependencies that could impact gold pricing more indirectly than immediately. Derivatives continue to shape market perception. Complex layers of options, spreads, and cross-asset hedges obscure the true supply-demand balance. Market participants tracking these positions warn that any forced unwind or sudden adjustment could accelerate price movements, particularly in silver, where positions are more concentrated relative to available physical inventory. The gold-silver ratio is sending unusual signals. Historically a reliable indicator of relative value, current movements suggest it is being distorted by derivative positioning, ETF flows, and industrial demand pressures. Analysts caution that relying on historical ratios may underestimate the probability of sharp divergence if structural market pressures intensify. Global macro correlations are shifting in subtle but meaningful ways. Metals are decoupling from traditional influences such as interest rate movements, equity swings, and currency fluctuations. Algorithmic trading systems amplify these deviations, sometimes reinforcing unexpected spikes or dips. The risk is that reliance on historical models may misrepresent potential exposure, leaving both institutional and retail participants vulnerable. Regulatory gaps add further uncertainty. Modern trading structures, cross-border allocations, and synthetic derivatives create blind spots in oversight. Reports indicate that substantial risk positions can accumulate without detection, raising questions about the resilience of the system under stress. These unmonitored concentrations have the potential to exacerbate market corrections when triggered. Physical custody concentrations remain a key structural vulnerability. A handful of major vaults hold disproportionately large shares of inventory, concentrated by region and operator. Operational disruptions, policy changes, or jurisdictional challenges could trigger immediate pressure on both paper and physical markets. Analysts warn that the interplay between these concentrations and derivative positions creates a dynamic that is both opaque and potentially fragile. Market signals are beginning to reflect subtle shifts in investor confidence. While headline prices remain relatively stable, order book analysis shows widening spreads and thinner depth, particularly in silver. This suggests that participants are wary of sudden moves and may adjust positions more aggressively in response to even minor disruptions. Reports indicate that these micro-level hesitations can quickly cascade into broader market effects. Industrial demand for silver is creating underlying pressure that isn't immediately visible in price charts. Emerging technologies and manufacturing applications are steadily increasing consumption, while mine production and refining capacity are constrained. Analysts tracking these dynamics suggest that even marginal supply delays could exacerbate volatility, raising questions about the market's ability to absorb stress without disproportionate reactions. Gold continues to function as a stabilizing anchor, but incremental central bank actions are subtly shifting liquidity flows. Changes in reserve allocations, coupled with currency hedging strategies, suggest that gold is being leveraged as both a hedge and a strategic asset. The consequences of these incremental shifts may not appear in short-term pricing, but could recalibrate correlations across multiple asset classes. Derivative positioning is amplifying potential risk. Layers of options, spreads, and synthetic hedges obscure true supply-demand dynamics, creating conditions where price movements can accelerate once stress points are hit. Analysts warn that silver, with its smaller and more concentrated market, is particularly vulnerable to these chain reactions, where the unwind of complex positions could magnify volatility dramatically. The gold-silver ratio is showing persistent anomalies. Its historical reliability as a relative valuation tool is being challenged by derivative activity, ETF flows, and industrial demand pressures. Market behavior implies that these distortions could become the norm rather than the exception, forcing traders and analysts to reassess traditional hedging and valuation strategies. Cross-asset correlations are increasingly unpredictable. Metals are reacting less consistently to interest rate changes, equity swings, and currency movements. Algorithmic trading systems compound these deviations, occasionally creating feedback loops that accelerate movement without a clear fundamental trigger. Understanding these dynamics is essential for interpreting abrupt swings and anticipating potential tipping points. Regulatory oversight remains a latent concern. Rapidly evolving trading instruments, electronic platforms, and cross-border allocations create blind spots in monitoring risk concentrations. Reports suggest that substantial positions of systemic relevance can accumulate without detection, raising the potential for amplified reactions when market corrections occur. Physical custody patterns add another layer of complexity. Concentration in a limited number of major vaults and operators increases vulnerability to operational, policy, or jurisdictional disruptions. Analysts caution that these concentrations, combined with derivative positions and liquidity pressures, create a structural fragility that could precipitate abrupt market responses if stress conditions arise. Investor psychology is shifting quietly, shaped less by headline prices than by perceptions of risk and liquidity. Reports indicate that participants are increasingly defensive, adjusting positions preemptively rather than reactively. This subtle shift may not appear in daily trading volumes but has the potential to influence market dynamics once stress triggers intersect with thin liquidity windows. Silver's market is showing stress signals that remain largely invisible in aggregate data. Refining bottlenecks, transportation delays, and concentrated holdings suggest that minor operational issues could quickly cascade into broader price movements. Analysts monitoring these indicators note that paper contracts may not fully reflect these structural vulnerabilities, creating potential for sudden dislocations. Gold, while more stable, is also experiencing understated pressures. Central banks' strategic reallocations and hedging maneuvers suggest incremental but systemic shifts in global liquidity flows. Even modest adjustments can ripple across currencies, bond markets, and equities, subtly altering correlations that investors rely on to manage risk. The consequences may only become apparent when multiple stress points coincide. Derivative overlays continue to obscure the true supply-demand landscape. Complex positioning in options and futures can create latent pressures, particularly in silver, where concentrated positions magnify the impact of any unwind. Market participants warn that these layers may accelerate price moves in ways historical patterns would not anticipate, introducing non-linear risk dynamics into otherwise familiar markets. The gold-silver ratio is defying traditional expectations. Deviations from historical norms reflect derivative activity, ETF flows, and industrial demand pressures rather than fundamental scarcity alone. Analysts caution that relying on historical relationships may misrepresent risk exposure, particularly in periods of structural adjustment, where traditional valuation signals lose reliability. Cross-market interactions are becoming more complex. Metals now respond in nuanced ways to interest rate shifts, equity market fluctuations, and currency movements. Algorithmic trading systems detect and exploit these interactions, sometimes reinforcing unexpected spikes or dips. The challenge lies in disentangling structural market shifts from transient, technical-driven movements to understand true risk. Regulatory gaps continue to create latent vulnerabilities. Rapid innovation in trading instruments and cross-border allocations allows significant risk positions to accumulate without detection. Analysts note that this opacity could amplify market corrections if multiple pressures converge simultaneously, creating conditions where conventional safeguards are insufficient. Finally, physical custody patterns remain a critical vulnerability. Concentrated holdings in a small number of major vaults, combined with derivative positions and thin liquidity, create potential flashpoints. Any operational disruption or jurisdictional change could trigger immediate market reactions, emphasizing the need to understand both the overt and hidden forces shaping these markets. Emerging patterns in investor positioning suggest the market may be approaching a subtle tipping point. While headline prices remain relatively contained, Open interest and concentrated holdings point to latent pressures that could amplify once a trigger occurs. Analysts tracking these signals warn that the market's apparent calm may be masking underlying fragility. Silver continues to show structural vulnerabilities. Concentrated supply chains, refining constraints, and limited physical inventories mean that even minor disruptions could propagate quickly. Reports indicate that paper markets, disconnected from actual availability, could exacerbate volatility if stress conditions coincide with derivative unwinds. The interplay between these forces may create scenarios that historical patterns fail to anticipate. Gold's behavior appears less volatile, but central bank strategies introduce nuanced risk. Incremental reserve adjustments and hedging maneuvers subtly shift liquidity across currencies and bonds, influencing correlations in ways not immediately visible. These small but systematic movements can alter the context in which metals respond to macroeconomic or geopolitical events, leaving investors reliant on historical assumptions exposed. Derivative markets continue to add hidden complexity. Options, spreads, and synthetic positions obscure supply-demand signals, creating a system where market reactions can accelerate once stress points are engaged. Analysts caution that silver is particularly susceptible, given its smaller market and concentrated positions relative to available physical metal. The gold-silver ratio is increasingly signaling structural divergence. Historical norms are less reliable as derivative flows, ETF activity, and industrial demand reshape relative valuations. Market participants must reconsider conventional hedging strategies and valuation models to account for this evolving baseline. Cross-asset correlations remain unpredictable. Metals now react in subtle ways to interest rate shifts, equity swings, and currency movements, often influenced by algorithmic systems that amplify micro-movements. Understanding these feedback loops is essential to anticipating sudden adjustments and navigating latent volatility. Regulatory oversight continues to lag behind market innovations. Electronic platforms, cross-border allocations, and complex derivatives create blind spots where significant risk positions can accumulate unnoticed. Analysts warn that this opacity increases the potential for amplified corrections when structural pressures intersect. Finally, concentrated physical custody remains a persistent vulnerability. Key vaults and operators hold disproportionately large inventories, exposing the market to operational, policy, or jurisdictional risks. Combined with paper market pressures and derivative overlays, these factors create a complex, interdependent environment where a seemingly minor disturbance could cascade into broader market adjustments. The dynamics in gold and silver markets are quietly shifting, driven by a complex interplay of physical constraints, derivative positioning, and strategic institutional behavior. What appears as stability on the surface masks underlying pressures that, if triggered, could accelerate movements far beyond what historical patterns suggest. Silver's structural vulnerabilities, concentrated supply, refining limits, and industrial demand interact with paper markets in ways that can amplify volatility unexpectedly, while gold's seemingly steady behavior is influenced by subtle central bank maneuvers and global liquidity flows. Derivative overlays, cross-asset correlations, and algorithmic trading add layers of opacity, creating feedback loops that make predicting outcomes more challenging. Regulatory gaps and concentrated physical custody further compound these latent risks, meaning that market shifts could occur suddenly and with intensity. The evolving gold-silver ratio signals that traditional valuation measures may no longer provide reliable guidance, forcing participants to reassess conventional assumptions. Taken together, these factors suggest a market environment where incremental actions, structural stress points, or unforeseen disruptions could trigger disproportionate effects. Understanding these interconnections and recognizing that apparent calm does not equate to resilience is essential for navigating the metals market today. The current configuration demands close attention, measured analysis, and a readiness to interpret subtle signals before they manifest in significant price movements.